Everything you need to know about dark pools in the stock market. Dark pools are secret markets where investors can trade securities that are not available to the general public. These exchanges are often called as black pools of liquidity, a reference to their utter lack of transparency. Dark pools were created largely to make block trading easier for institutional investors who didn't want their massive orders to disrupt the markets and result in unfavorable trade prices. Dark pools are sometimes portrayed in a negative light, although they serve a useful purpose by allowing massive trades to take place without disrupting the rest of the market. Their lack of transparency, on the other hand, makes them exposed to potential conflicts of interest on the part of their owners and predatory trading activities on the part of some high-frequency traders. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. When the Securities and Exchange Commission (SEC) allowed brokers to trade big blocks of shares in the 1980s, dark pools arose. Electronic trading, as well as a 2007 SEC regulation aimed at increasing competition and lowering transaction costs, has sparked an increase in the number of dark pools. Because dark pools are generally hosted within a major corporation rather than a bank, they can charge cheaper costs than exchanges. Bloomberg LP, for example, owns the dark pool Bloomberg Tradebook, which is registered with the Securities and Exchange Commission. Institutional investors use dark pools for block trades involving a large number of stocks at first. Dark pools, on the other hand, are no longer reserved for huge orders. According to a Celent study, the average order size has decreased from 430 shares in 2009 to around 200 shares in 2013. This is due to block orders going to dark pools. The main benefit of dark pool trading is that institutional investors can make huge trades without exposing themselves while looking for buyers and sellers. This avoids a significant price devaluation that would otherwise occur. If the fact that an investment bank was trying to sell 500,000 shares of a security became public knowledge, the security's value would almost surely have dropped by the time the bank found purchasers for all of their shares. Devaluation is becoming a more likely possibility, and electronic trading platforms are driving prices to respond to market pressures much more swiftly. However, if the fresh data is only released after the deal has been completed, the news has a far smaller influence on the market. The benefits of dark pools. Non-exchange trading has recently grown in popularity in the United States, according to the CFA Institute. According to estimates, it accounted for over 40% of all stock trading in the United States in 2017, up from an estimated 16% in 2010. According to the CFA, dark pools accounted for 15% of total volume in the United States in 2014. Why were dark pools created in the first place? Consider the choices available to a major institutional investor looking to sell 1 million shares of XYZ stock before non-exchange trading was introduced. This investor could do one of the following. 1. Work the order through a floor trader over 1 or 2 days and hope for a reasonable volume-weighted average price. 2. Divide the order into 5 pieces, for example, and sell 200,000 shares per day. 3. Sell tiny quantities at a time until a large buyer is discovered who is willing to buy all of the remaining shares. The market impact of selling 1 million XYZ shares may still be significant, regardless of the investor's choice, as it was not possible to conceal the investor's identity or intent in a stock exchange transaction. The risk of a decline in the period while the investor was waiting to sell the remaining shares was similarly considerable with alternatives 2 and 3. One solution to these problems was the use of dark pools. Why would you use a dark pool? Compare this to today's situation, when an institutional investor can sell a 1 million share block through a dark pool. The lack of transparency benefits the institutional investor, since it may result in a higher realized price than if the sale were made on an exchange. There is no order book visible to the public since dark pool members do not disclose their trade intentions to the exchange before execution. After a wait, trade execution details are released on the consolidated tape. Because a dark pool is a forum targeted to large investors, the institutional seller has a better chance of finding a bidder for the entire share block. If the transaction is conducted at the midpoint of the quoted bid and ask prices, there is the chance of a price improvement. Of course, this implies that the investor's anticipated sell isn't leaked and that the dark pool isn't exposed to high-frequency trading, HFT, predators who would try to take advantage of the investor's trading intentions. Dark pools come in a variety of shapes and sizes. There were more than 50 dark pools registered with the Securities and Exchange Commission (SEC) as of February 2020, divided into three types. Dark pool run by brokers and dealers. Large broker-dealers create dark pools for their clients, which may contain their own proprietary traders. Price discovery is present since these dark pools derive their own pricing from order flow. Credit Suisse's Crossfinder, Goldman Sachs' Sigma X, Citibank's Sigi Match, and Morgan Stanley's Miss Pool are examples of dark pools. Exchange-owned dark pool or agency broker. This is a dark pool that acts as an agent rather than a principal. There is no price discovery because prices are generated from exchanges, such as the midpoint of the National Best Bid and Offer (NBBO). Instinet, Liquidnet, and ITG Posit are examples of agency broker dark pools, while BATS Trading and NYSE Euronext offer exchange-owned dark pools. Dark pools of electronic market makers. Dark pools are provided by independent operators like Getco and Knight, who act as principals for their own accounts. Their transaction pricing, like those of broker-dealer-owned dark pools, are not based on the NBBO, hence there is price discovery. 4. The benefits and drawbacks of dark pools. The primary benefit of dark pools is that the market impact on large orders is considerably decreased. Because dark pool trades do not incur exchange fees and transactions based on the bid-ask midpoint do not incur the whole spread, dark pools may reduce transaction costs. Stock prices on exchanges may not reflect the actual market if the quantity of trading in dark pools held by broker-dealers and electronic market makers continues to expand. For example, if a reputable mutual fund has 20% of firm RSD stock and sells it in a dark pool, the fund may receive a decent price for the position. Unwary investors, who just purchased RSD shares on the other hand, may have overpaid because the stock may plummet once the fund sale is made public. Because there is no guarantee that the institution's deal was executed at the best price, the lack of transparency in dark pools might operate against a pool participant. Even in circumstances where the broker-dealer has a small part of the U.S. market, a shockingly substantial proportion of broker-dealer dark pool deals are completed within the pools, a process known as internalization. If a broker proprietary dealer's traders trade against pool clients, or if the broker-dealer provides privileged access to the dark pool to HFT firms, the dark pool's opaqueness can lead to conflicts of interest. Controversies. Despite the fact that regulated dark pools are lawful and regulated by the SEC, they have been criticized for their lack of transparency. Because dark pool trades are not exposed to the general public, high-frequency trading firms have sometimes utilized them for predatory acts, such as pinging dark pools to uncover big secret orders, and then engaging in front-running or latency arbitrage. Dark pool operators have also been accused of misrepresenting their pools to their clients or exploiting their dark pool data to trade against their other customers. Securities regulators have recovered more than $340 million from dark pool operators to settle various litigation charges, according to the Wall Street Journal. 5. In dark pools, the average trade size has shrunk to around 200 shares. Dark pools and alternative trading systems, according to exchanges like the New York Stock Exchange, NYSE, are losing trading market share to dark pools and alternative trading systems because of the small trade size. Controlling dark pools. Some market pundits would have you believe that dark pools are a complete version of the financial Wild West. Dark pools are genuinely regulated, with national financial authorities in each country monitoring and police their activities and business practices. As dark pools have risen in popularity, authorities and politicians have been more interested in how they are run. As a result, dark pools are being subjected to new and revised law that regulates their operations. Dark pools have received a lot of regulatory scrutiny as a result of the recent HFT scandal. Because of their lack of transparency, dark pools have been viewed with distrust by regulators. This uproar may prompt further efforts to limit their appeal. A pilot proposal from the Securities and Exchange Commission (SEC) to adopt a traded rule could help exchanges recapture market share from dark pools and other off-exchange venues. Brokerages would be required to transmit client trades to exchanges rather than dark pools unless they can execute the trades at a significantly lower price than the public market. This law, if adopted, might pose a severe threat to the long-term viability of dark pools. Dark pools aren't going away anytime soon. Legislation will alter and transform the way dark pools do business and operate, but dark pools are not a new concept. The requirement to trade big blocks of shares with little market impact will always exist. That's why, before dark pools, brokers negotiated and agreed on block trades outside of regular stock market trading hours. Dark pools are just the result of that evolution. Dark pools can be advantageous for investors looking for both price enhancement and low price impact when they are handled honestly and according to established guidelines. Investors will always require the ability to trade in a dark pool. Key takeaways. Dark pools are secret markets where investors can trade securities that are not available to the general public. Dark pools were designed to make block trading easier for institutional investors who didn't want their massive orders to disrupt the markets and result in lower prices for their trades. As of May 2021, there were 59 alternative trading systems, aka dark pools, registered with the SEC, according to the most available SEC data. Final thoughts. Dark pools offer pricing and cost advantages to buy-side organizations like mutual funds and pension funds, with the expectation that these advantages will be passed on to individual investors who own these funds. Dark pools, on the other hand, are vulnerable to conflicts of interest by their owners and exploitative trading activities by HFT businesses due to their lack of transparency. Dark pools have been under increased regulatory scrutiny as a result of the HFT scandal, and the proposed trade-it rule could jeopardize their long-term sustainability. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.